Ladies and gentlemen, good day and welcome to Sapphire Food India Limited conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand over the conference to Mr. Sanjay Purohit. Thank you, and over to you, sir.
Everybody, welcome to the Sapphire Foods Q1 FY26 financial highlights presentation. I'm joined by Vijay Jain, our Executive Director and CFO. As always, the two of us will play a tag team and take you through our results for Q1. Let me just jump in straight away. We delivered a revenue of 775 crores, which was 8% growth over last year. In this quarter, we added 8 KFC restaurants, 2 Pizza Hut in India, and 1 Pizza Hut in Sri Lanka. Our total restaurant count is 974 at the end of the June quarter. Our consolidated restaurant EBITDA declined by 13% year-on-year. Margin was 12.2%, which is 290 basis points down. Our adjusted EBITDA was 55 crores. It declined 22% year-on-year, and adjusted EBITDA margin was 7.1%. Our consolidated EBITDA post-Ind AS was 113 crores, or 14.6%, and this declined 9% year-on-year, 270 basis points below last year. Our consolidated PAT was negative 2 crores, or 0.2%, and our consolidated adjusted PAT was positive at 6 crores, or 0.7%. Let me dive into the KFC brand priorities. This is on page number 20. We drive 6 priorities on the KFC brand. One is to increase penetration and therefore increase the consumer base for KFC and drive frequency. We want to be known for craveable taste. Value is an important component of strategy. Operationally, how do we deliver a frictionless customer experience? And operational excellence, whether it is customer service in the store or through the aggregators. And finally, how do we improve accessibility? This quarter, KFC had a SSSG which was flat over last year. However, transaction growth was positive, which is encouraging. And transaction growth was positive because gross margin also was negative. We invested behind the Epic Savers campaign. This Epic Savers campaign of abundant value, 9 for 299, has given us positive transaction growth. Our SSSG still is, the results on SSSG are still yet to come. Apart from that, we launched the Gold premium range of Zinger Burger and chicken strips. Our kiosks are now implemented in 259 stores, and there are some pictures of the new restaurants that we have launched. For the channel-wise mix and other financial numbers, I'll hand it over to Vijay now.
I'm on slide number 24, which gives channel-wise mix. The dining and takeaway mix came at 57% and delivery at 43%. Delivery mix, while it was similar to the previous quarter, but if you look at year-on-year, there is a 300 basis points increase in delivery mix. The SSSG was flat, as Sanjay called out. However, the same store transaction growth, SSTG, was positive low single digit, which was very encouraging. Overall revenue grew by 11%, and gross margin dropped by 90 bps. This was result of the investment which we did behind the various value offers and promotions. From an inflation point of view, while there was some inflation, we were largely able to neutralize those inflation with the cost saving initiatives. So the entire impact on gross margin you see is because of the investment behind the value campaign and the value offers. The drop on gross margin along with the higher delivery mix and operational deleverage because of the flat SSSG meant that restaurant EBITDA came at 15.7%. Slide number 27, which gives you a 4-year annual view and 5-quarter trend. We continue to invest behind our strategy of value campaign, and we are confident that this should help us drive transactions and ultimately the SSSG.
Let's go to Pizza Hut. The Pizza Hut, I'm talking about slide number 29. We had given a clear path on revival of the brand, which apart from driving taste superiority, also had a component of investing significantly higher amounts of marketing monies to drive consumer behind mass media advertising to drive consumer awareness and consideration. From a numbers perspective, Pizza Hut had a negative 5% overall revenue growth and a negative 8% SSSG. Let me try and give you some details of what happened during the quarter. First, we launched the Juicylicious pizza range in April 25. This has received really positive feedback from consumers who've tried it. However, the Juicylicious pizza campaign was supported by mass media differently in Tamil Nadu, which is an exclusive Sapphire state, and the rest of the market. In the rest of the country, including the common markets of Sapphire, we supported it largely through below-the-line advertising, which means that proximity advertising in malls or in hoardings around our stores. We know that that is suboptimal. In Tamil Nadu, however, we supported it with mass media advertising. There's a YouTube link that we have provided on our presentation that will enable you to see the ad. So Yum and Sapphire put money behind creating consumer awareness. There the brand did well. In fact, there is a double-digit SSSG difference between Tamil Nadu and the rest of our market. In Tamil Nadu, we delivered low positive single-digit SSSG when compared to last year. If you remember, we had got a 17% sequential uplift from Jan, Feb, March 24 to April, May, June. On top of that April, May, June 24, Tamil Nadu delivered a low single-digit positive SSSG. It gives us confidence that this is the strategy to revive the brand, which really is a replica, and I've said this many times, of the successful strategy that we run in Sri Lanka, where omni-channel, great product, great value, and strong advertising enables the customer to choose us versus other pizza brands. Quick look at the numbers.
Yeah, I'm on slide number 35, channel-wise mix. That has largely remained steady quarter on quarter, as well as when you compare to last year, it has remained steady. 50% been contributed by delivery and the balance 50% through dining and takeaway. SSSG was -8% and overall brand degrew by 6%. Gross margin dropped by 150 basis points compared to last year. And here again, a huge amount of investment behind the value offers, promotions and campaigns, and very small or marginal impact on account of inflation. The gross margin drop combined with the negative impact of the SSSG or the operating deleverage meant that restaurant EBITDA came down to -2.5%. And as Sanjay called out previously, that if If we exclude the factor of additional marketing investments which has gone into the brand, this is over and above the agreement with Yum, the brand is actually at a break-even level. Slide 38, this gives you a 4-year and 5-quarter trend. We continue to work with Yum so that we can replicate the Tamil Nadu and Lanka strategy across all our markets.
On Sri Lanka continued to show robust double-digit SSSG and TG. In fact, SSSG came in at 12% and system growth was 15%. We have 126 stores in Sri Lanka. Now, 12% SSSG typically would have translated into positive operating leverage. However, we faced very steep employee cost inflation because of a change of minimum wages. There were two changes that happened, one in September, October of last year and one in May, but which was retrospective in effect from 1st of April. And both these had a sharp impact on our restaurant EBITDA, which was 30 basis points higher than last year. Vijay, some of the numbers, please.
Slide number 42. The channel-wise mix again for Sri Lanka business has largely remained steady. Dining and takeaway at 61% and delivery at 39%. SSSG of 12% alongside the double-digit transaction growth and same-store transaction growth I'm calling about. From a revenue, 15% growth in LKR terms and 19% growth in Indian rupee terms. Gross margin was higher by 30 basis points over last year. Overall, restaurant EBITDA came in at 12.7%. And as Sanjay called out, we couldn't really see the margin expansion because the benefit of SSSG was largely offset by the increase in minimum wages with effect from 1st of April. Slide number 46 again gives you the 4-year trend and 5-quarter trends. The business continues to deliver robust performance and we expect to mitigate this minimum wage impact starting quarter 2 onwards. We have taken a price increase of 3 to 5% in Sri Lanka and we expect at least quarter 2 we should be able to deliver slightly better improvement over margins Q on Q at least.
Finally, on sustainability, it is part of our everyday existence. We are really happy to announce that our Raiya store in the KFC Raiya store in Punjab received an Indian Green Buildings Council Platinum Award, and this is the first QSR restaurant in India to receive this award and the first Yum KFC restaurant globally also to receive this award. So we're quite proud of this. And with this, we conclude our commentary. We'll open it up now for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove from your question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tejas Shah from Andrews Park. Please go ahead.
Hi, thanks for the opportunity. Sanjay, the first question pertains to KFC. What's driving this disconnect between improving ADS but contracting margins?
The improving ADS that we see in quarter 1 versus quarter 4 is a natural seasonal uplift that we see. The contracting margins, when you see 0% SSSG, and now if I just look back on 3 years SSSG, 3 years ago it was 0% in quarter 1. I'm talking about FY 23-24. 24-25 it was negative, and now 0%. So it's really operating deleverage coming into play, Tejas.
Tejas, additionally, I am sure you're referring to quarter 4 versus quarter 1 comparison, where we have delivered higher ADS in a similar restaurant EBITDA. The biggest impact which you see Q4 versus Q1 is the gross margin. We would have invested almost 100 basis points to enable us drive transactions. So that's the single biggest factor. There would be additional factors. Typically, in quarter 1, you do wage revisions. There's the salary increments which comes in. So those are additional costs which comes in. There's also marginally higher marketing which we would have done in KFC also for this quarter, while we continue to invest behind the brand within the overall agreement range. But during the quarter, we have chose to invest slightly higher. It will get balanced out through during the year. So these are the 3 reasons.
Yeah. And generally, April, May, June, from a utilities perspective, etc., also versus Jan, Feb, March, we will see, because of summer, an increase in cost. So quarter 4 versus quarter 1 is strictly not comparable.
Yeah, no, I was just looking at 3Q also when we were at around similar number 115, 115, and we had 18.2. Obviously, mix because it's a festive season, perhaps the mix changes. But we, in fact, not very much long back, Sanjay, on the call, you had guided us that SSG has a lesser forecasting significance in current environment than ADS on margins. So I was just curious that is it true for the industry that the cost of ADS or cost of SSG has gone up now? So what we saw, let's say 2 years back, that a certain SSG or certain ADS was delivering certain margins, the cost of that ADS has gone up materially.
Yeah. So actually we were guiding that on Pizza Hut, not so much on KFC. So there is a SSSG finally is important, and when you see SSSG in consonance with ADS improvement, that's the time when so both are important, Tejas, in a sense. Yeah, both are important.
Okay. That's clear. Second, pertaining to Pizza Hut, so you clearly mentioned that intervention that we have done in Tamil Nadu is definitely benefiting the brand and improving performance also. So what's preventing a pan-India rollout if we are seeing benefit, at least I'm seeing parent and then you are seeing benefit of this. So what's the hurdle there?
Yeah, so I think eventually it will happen. I'm confident of this. Right now, it is a factor of our estate being very different. See, when you have an estate which is dine-in forward omni-channel, consumers come to the store, see the difference. Advertising also drives consumers to the store, and it gives it gives a further positive rub-off. Like I've said, it's not out of thin air that we believe this can work, because this is our Sri Lanka template. I'm quite confident that over a period of time, we should be able to get this to work in the rest of the country also.
Okay. And lastly, on competitive environment, if you can comment, has it improved or still remains the same?
Sorry to interrupt. May we request you to please come back for the follow-up question, as there are several participants waiting.
Since I've heard this, let me just answer. Since Tejas has got his question in, so I'll just answer it. So from a competitive environment, I don't think anything has materially changed, Tejas. So there's nothing that has materially changed, not over the quarter, I would say over the year also.
Thanks and all the best.
Thank you.
Thank you. The next question is from Gaurav Jogani from JM Financial. Please go ahead.
Thank you for the opportunity, sir. Sir, we are seeing, as you also highlighted, that despite very low bases, we are still struggling to even touch mid-single digit SSSGs. So if you can break this problem into two parts, one is the overall macro factor, that is impacting this. And the other would be, any other thing that you can highlight, that is halting the growth even on a low base.
Yeah. So the macro factor is undoubtedly present, as we can see in the in the results that almost every consumer company has. So, however, it is impossible for any of us to predict when these macro conditions will change. So, you've heard us say repeatedly, we are trying to do everything possible within these macroeconomic conditions to change our trajectory. I am quite confident on KFC that we should be able to start changing this soon. What are we focusing on? We are focusing on really, at a consumer level, there are two consumers. We believe that the biggest opportunity for KFC is in increasing the consuming base for KFC. The ability to do that will be to focus on our core product and on value. We have seen one expression of value, which is the 9 for 299. You will see a lot more of these expressions coming in, in the future. We also need to have advertising that appeals to that first-time user of KFC. So that will also happen shortly. And to drive greater frequency of consumption, we've got innovation like the Gold Zinger Burger. We've got, during summer we launched a new range of drinks. Our late night delivery is quite strong now. We have got a very initial pilot for breakfast and coffee. So these are we look at consumers from two lenses: increased frequency, increased penetration. I think it takes time to turn around inertia from a flat SSSG to positive SSSG. But once it turns around, I'm quite confident that this will give us good results. Apart from everything else that we are doing from an operational perspective, we continue to lead in terms of our operational metrics, whether it's at a customer satisfaction level, our ratings, etc., etc. So we are quite happy on how we are executing on store. The consumer part we have to get right, and it is taking time. But we're going to double down and get execution right more than anything else.
Thank you for the detailed answer, sir. And my second and last question is with regards to the overall margins across the three formats. Overall, the margins across the three formats, given the constraints that we are operating into, at least we can say at the current levels, the margins have bottomed out at least, if not accelerating, but at least they would have bottomed out at current levels.
They would have bottomed out except for, let's say, the seasonal impacts, right? So typically, for example, quarter 2 for KFC is lower than quarter 1 in terms of the various vegetarian days which the quarter 2 encounters. Quarter 3 can be again higher. So I would say at these SSSG levels, which is a flat SSSG levels, there should only be now seasonal impacts which should play out. And any improvement in from SSSG should probably help us get margins back.
Yeah. And I'm just tying this back to the question that Tejas asked. So it's a combination of SSSG and ADS. Typically, quarter 2 shows a lower ADS, and that impacts profitability. So whatever is the SSSG, if the absolute ADS levels are lower, so that will have an impact. So it's a combination of SSSG and ADS that impacts final restaurant margins.
Yeah, so my question was more on the annual and not on the quarter basis, but more on the annual.
Yeah. I think there is no point in giving longer term guidance. I think we'll see the bill.
Sure. All right. Thank you, sir. That's all.
Thank you. The next question is from Saurabh Kundan from company Goldman Sachs. Please go ahead.
Yeah, thank you. My question is also around the margins. Vijay, you just mentioned that you've done slightly higher marketing spends in KFC. So when you said that at flat SSSG, only the seasonal quarterly changes in margins will be seen, are you adjusting for that ad spend? Because usually 1Q has a much higher margin than what you reported.
So when I called out the overall impacts from Q4 to Q1, and this is what I was answering Tejas' question, there I was just trying to give a bridge in terms of gross margin impacts, which was the bigger one, delivery mix impact, which is a smaller one, the utility cost, and there was a marginal impact of marketing. I would not call it a material to say that I need to adjust for the future margins. I would not call it that way.
Okay. So the 67 odd % gross margin that we have now, is it the baseline now? Or like Sanjay just mentioned that we are seeing just the starting of value initiatives, we'll see more in such expression. Does that mean that we could...
I would not use the word as a baseline. I would say that whatever is required to now get the transactions and SSSG going, we are prepared to do that. So this entire Epic Saver campaign, which we ran starting May onwards, is already part of the impact we are seeing in Q1, but it may not be full impact. The positive part is we have seen transaction growth for the first time, SSTG for the first time after, I would say, 12 consecutive quarters. Hence, I think we would be a bit more flexible on those gross margin numbers if it can eventually result into a higher transaction growth and higher SSSG. So I would not tie down my strategy that I don't want to move away from this baseline number. We would be flexible and we'll take a call as we move forward.
Got it. Interesting. Last question on Pizza Hut. You have shown that marketing does change the performance a little bit, quite a lot actually. You mentioned double-digit differences there. And so if you can share with us then, what is the future of this format pan-India then? I mean, when would Yum take a call on how to go forward on the brand overall in India?
So again, when we say future of the format, this is the format which Sapphire now runs across all its market. I think the complication is that there is an overlap of the territory between us and the other franchisee. The other franchisee operates a delivery format in our territory. So that creates a confusion in terms of how do we go about the strategy. Having said that, it's nothing new. For last 7 years of Sapphire existence, this problem existed and we were able to navigate through it. It's only that the other franchisee haven't seen the same kind of results the way we have seen, and hence this slight difference of opinion which we're experiencing over last 2 quarters. But now that we have again seen a positive results in the way we have gone about it, I'm sure it's only a matter of quarter or 2 before all the 3 parties are on the same page and we can execute uniformly pan-India.
Okay, thank you.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Hi. Thanks for the opportunity. Sir, there is a growth divergence between channels for us, right? So for KFC specifically, dining growth is 5%. Delivery is doing well at around 20%, right? So we have been trying to improve this growth with, as you mentioned, Tasty Epic campaign, where these are dining specific campaigns that we are doing. But that is so far not led to improvement in dining growth, right? So wanted to better understand the reason behind slower growth for this channel specifically. And a follow-up to this is you've also mentioned that delivery mix increase has some impact on your margins as well. So do you foresee a structural margin reset as well because of higher delivery?
So Devanshu, while I am not clear about the numbers you quoted on the dining and the delivery, how you arrived at those numbers, having said that, I have understood your question in principle. that your dining is still not performing to the level your delivery is, and that's a fair comment. The Epic Saver and the promotions and those campaigns definitely has helped us reduce the gap between the dining performance and delivery performance. That's for certain and sure, but not to the extent we would have liked it. And that's also reflected in the overall SSSG being flat. And that's the endeavor that will continue to go down this route of investing behind the brand in form of value offers and campaigns. Even in the next quarter, you will see us double down on these value offers. Right now, 9 for 299, you are seeing. Maybe in H2, you will see even more aggressive campaign on sub 100 rupees as well. So the plans are there in place through which we believe we can get back dining and takeaway. And at the same time, the delivery can grow at its own pace. The second part of the question, which was, is there a structural shift you are seeing and the delivery mix has increased? The delivery mix has increased compared to the last year quarter one. But if you look at the quarter 4 of last year and current quarter, the delivery mix has largely remained stable. So again, if I want to predict the rest of the year, we would say that it should largely be range bound in terms of the delivery mix.
Understood. Vijay, so I was trying to understand, as in, say, in FY23, when your margins, or even in FY24, when your margins were, say, 19-20% in KFC, and that was at a certain delivery mix of 36 to 38%, right?
Yep.
So at current level of delivery mix, so does that imply that we may structurally be lower at, say, 40 to 43% delivery mix, that we may not be able to do that kind of a margin? So that was the broader question.
Understood. So if you're trying to compare with 23, 24 or prior to that, the 37, 38 going to 43 and 5% impact would roughly impact my overall profitability by 80 bips. So that is the structural impact. So a 20 can be read as still 19, 19 and a half, but coming down to 15.7 is a function of the SSSG not coming through rather than a structural shift on delivery. So that's the only clarification. Delivery certainly will impact, but the structural impact is 75 to 80 bips only.
Okay, very clear, Vijay. Second question that I wanted to understand, for Sri Lanka, the LC growth is 15% and INR growth is about 19%. So can we expect this 4 to 5% currency benefit to accrue for full year FY26 as well? And allied to this is on margins as well. So you have indicated there is some minimum wage hike, but you have taken some price hikes as well. So what is the level of margins that we can sort of look for Sri Lanka business in FY26?
So on the first part of your question on how the forex will play out, I would not comment on that because there are a lot of factors which goes into how a forex would perform for the rest of the year. At least the past 1 year shows that the foreign currency has been quite steady. And hence we don't foresee any reason why it should be playing out any differently for the rest of the year. But I would avoid commenting in specific. Coming to the second part of the question in terms of margin, I think we would like to deliver an improvement in margin over last year. So Sri Lanka delivered an X amount last year. We would love to have few basis points improvement at least over that last year's margin. Which did not happen in quarter one because of the wage impact, but because of the price increase and other mitigation, I think we should still be able to deliver some margin improvement for the rest of the year.
Okay, this is for the rest of the year, but okay, I got it, Vijay. Yeah, thanks.
Yeah, good. Thank you so much. Thank you everybody for joining the conference. Parit, we don't have any more questions.
Yeah.
Do we close the conference now?
Okay. As there are no further questions, I hand over the conference to Mr. Sanjay Purohit for closing comments.
Yeah. Thank you so much everybody for joining the quarter one financial highlights presentation. We'll see you in another 3 months for our quarter two and first half results presentation. Have a good rest of the day. Bye.
On behalf of Sapphire Foods India Limited conference call, that concludes this conference. Thank you for joining us, and you may now disconnect your line.
If you found this video helpful, please like, share and subscribe for latest upcoming videos.